Welcome to the deep dive. Today we're looking at something pretty fundamental at the very architecture of the global economy. And, well, some big shifts happening just below the surface. We're digging into China's long game, this really complex strategy to rely less on the U.S. dollar, de-dollarization.
Yeah, it's like a massive financial chess game playing out. And our job today really is to unpack how China's combining two very different tools here.
Right.
You've got the ancient allure of gold, massive amounts of it, and then this super modern, cutting-edge digital currency push.
Still old meets new.
Exactly. And it's not just about which currency wins. It's about, financial independence, managing global risks, and maybe, just maybe, moving towards a world with multiple major financial centers, not just one dominated by the dollar.
Okay. And since this stuff can get complicated fast, we're really going to try and use that Feynman technique, break it all down simply. So let's start right there with the core idea. De-dollarization. What does that actually mean in simple terms?
Okay, simply put, it's countries deliberately trying to use the U.S. dollar less for everything.
Everything.
Well, three main things. First, for trade. So pricing oil or grain or whatever in something other than dollars. Second, finance, trying to cut the dollar out of the loop when money moves across borders. And third, maybe the most important, central bank reserves. That's the emergency stash of assets countries hold. They're trying to hold fewer dollars there, too.
And why? What's the big motivation? I mean, the dollar's everywhere.
Well, that's kind of the point. Its dominance gives the U.S., not just advantages people talk about, exorbitant privilege, but real geopolitical power.
Like sanctions.
Exactly like sanctions. The U.S. can effectively lock countries out of global trade just by cutting off their access to the dollar system. That's huge leverage.
Okay, so if almost all currency trading involves the dollar, and most commodities are priced in it, Washington holds a lot of cards.
They really do. So maybe an analogy helps here. Think of the global financial system like a giant ocean. For decades, the U.S. dollar has been the only really reliable deep-water port.
The only place the biggest ships, the biggest deals could safely dock.
Right. Everyone had to use that port, pay the fees, follow the port authorities' rules, the U.S. rules. De-dollarization, then, is like, it's like China and others trying to build their own safe ports.
Okay.
That's the gold part, the secure alternative harbor. And they're also building new direct shipping lanes. That's the digital currency and payment systems part.
So they can sail their ships without ever needing to go near the dollar port.
That's the goal.
Yeah.
It's mostly defensive, really, trying to make their economies less vulnerable to pressure from the West.
Got it. Okay, so to really get why China's gold strategy today is such a big deal, we kind of need to look back, right? There's a history here, a painful one.
Oh, absolutely.
Yeah.
Section 2. We need to talk about the Chinese gold yuan from 1948. It's this major cautionary tale, a total currency disaster that really shapes how they think now.
Why was it so bad? What happened?
Well, context is key. China was in chaos. The old currency, the Fabi, was basically worthless thanks to hyperinflation. We're talking inflation so bad, the money supply went from billions to over 600 trillion yuan by August 48. Savings wiped out, economy paralyzed.
Wow. So the gold yuan was supposed to fix that.
That was the idea, restore confidence. But the nationalist government totally botched it. They tried to force stability.
How?
They made people, especially the urban middle class, their supposed supporters, turn in their actual gold, silver, foreign money.
Wait, they forced them?
Yeah, forced exchange. You got these new paper gold yuan notes instead. They even set a legal rate. 1 gold yuan equals 0.222 grams of gold. A fixed peg.
Sounds like confiscation, almost. And I'm guessing it didn't work.
Disaster. Total disaster.
Yeah.
The government couldn't stop printing money. They were still fighting a civil war, remember? So the hyperinflation just kept rolling. That promise of gold backing, it vanished almost immediately.
So the paper became worthless again super fast.
Instantly. And it destroyed the wealth of the very people they needed. Some say the currency collapse actually helped speed up the communist victory on the mainland. The lesson learned was brutal. Don't ever promise physical gold redemption for your paper money if you can't control your spending. Don't force it.
Which explains why today's strategy is completely different.
Night and day. Today's approach is voluntary, it's global, it's patient. They're not trying to make the yuan convertible into gold on demand. They're just stacking gold as a separate strategic asset, a reserve asset.
Okay, so that brings us to what people are calling the gold binge. The scale of this buying.
Yeah.
It's hard to even picture.
It's genuinely historic. Central banks, especially in emerging economies, China, India, Turkey are big ones. They're buying gold like never before. 2022, that was the biggest year of central bank gold buying ever recorded.
How much are we talking?
Collectively, they added 11,136 tons, valued at something like $70 billion.
And China's central bank, the PBOC, is leading the charge.
Pretty much setting the pace, yeah. We tracked the official numbers, and they just kept buying. For 18 months straight, right through May 2024, they added gold every single month.
Any idea how much that was in total?
Over that 18-month period, the official additions were around 316 tons.
Okay, so officially, what were their total holdings then?
By late 2024, the official number was 2,264 tons. And just looking at, say, the end of September figures, that was 74.06 million troy ounces, worth about $283 billion at the time.
But you said official numbers. There's a catch, isn't there?
There's a huge catch. This is where it gets interesting. Pretty much every analyst who follows this agrees. The official number is likely only a fraction of what China actually holds.
Refraction, like how much?
Some estimates say the official figures might only be a quarter, maybe even less, of the total gold held by various state entities, the PBOC, sovereign wealth funds, maybe others.
Okay, but hold on. If this is a big strategic move, and they're deliberately being secretive, how can anyone be confident about these hidden reserve estimates? Isn't it possible people are just guessing high because, well, it helps the gold price if everyone thinks China's buying even more?
That's a really fair question. It's definitely not precise science. The estimates come from tracking a few things. You look at China's own gold mining output, they're a huge producer. Then you track the massive amounts of gold imported, mostly through places like Hong Kong and Shanghai.
Okay.
Then you try to estimate how much gold is actually used by Chinese consumers for jewelry, electronics, that sort of thing. The huge amount of gold coming in that doesn't seem to be accounted for by private demand.
Yeah.
Well, the assumption is that it's being quietly absorbed by the state.
So it's based on discrepancies in the flow data?
Exactly.
Yeah.
It's an educated guess, but it's a widely accepted one, partly because Beijing does have a track record of being very, very quiet about its strategic reserves.
Okay, so whether it's the official number or this much larger hidden number, the point is they're holding a lot of gold. What does that actually do to the global financial picture?
It makes a real difference. If you recalculate global reserves, not just based on currencies, but including gold valued at market prices, suddenly gold makes up about 15% of total global reserves.
15%.
Yeah. And just doing that calculation, adding in the gold, pushes the U.S. dollar share of allocated foreign exchange reserves down significantly, from around 55% down to maybe 48%. It's a quiet but definite shift away from dollar dependency.
And it's not just buying gold, they're selling dollar assets too, right? Like U.S. treasuries.
Absolutely. That's the other side of the coin. China used to hold something like $1.3 trillion in U.S. Treasury bonds back in the early 2010s now. As of mid-2024, it was down around $780 billion. They are actively reducing their exposure to U.S. debt and swapping it for gold.
Let's bring in Russia here. That relationship seems crucial to this whole strategy, especially since, well, recent events.
It's become absolutely critical, yeah. Russia was already a huge gold buyer for the last decade, often just buying up all the gold mined within Russia itself. But then, right before the 2022 invasion of Ukraine, they did something really deliberate.
What was that?
They shifted their entire national welfare fund, that's like their sovereign wealth fund, out of dollars and euros. They moved it all into just two things: Chinese yuan, about 60%, and physical gold, the other 40%.
Wow. That's basically preparing for sanctions, wasn't it?
Textbook preparation. And once the Western sanctions hit hard, gold became absolutely vital for Moscow. They needed to earn hard currency to keep some trade relationships going and just to provide some stability for their own monetary policy, with the ruble being so volatile.
And the sanctions probably pushed them even closer to China.
Massively closer. Russia now depends heavily on China for all sorts of things, including, crucially, equipment for its own gold mines. They need Chinese machinery and parts just to keep digging the gold out of the ground. So it's become this really tight, reciprocal relationship built on that shared goal. Let's find ways to trade and hold wealth that the U.S. can't touch.
Okay, so piling up gold is one thing, but if you actually want to use other currencies or gold-related assets, you need the plumbing, right? The infrastructure.
Exactly. Reserves are passive. You need active systems, which brings us to Section 3, what China is building right now, these alternative payment rails.
And the centerpiece seems to be the digital yuan, the ECNY. Let's do the Feynman thing again. Simple explanation. What is it?
Okay, the ECNY, or digital yuan, is basically digital cash. But unlike the money in your bank app, which is technically a promise from your bank, the ECNY is issued directly by China's central bank, the PBOC.
So it's a direct liability of the central bank itself.
Exactly. That makes it theoretically the safest form of digital money inside China. It's also traceable and potentially programmable by the government, which raises other questions. But for financial plumbing, the key is its direct central bank backing.
And China's way ahead on this compared to, say, the U.S. or Europe.
Miles ahead.
Yeah.
The U.S. Fed, the Bank of England, the ECB, they're mostly still just researching, maybe doing small tests. China, they kicked off large-scale pilots back in 2019.
2019, that's ages ago in tech terms.
It really is. Those pilots started in big cities like Shenzhen, Suzhou, and now they cover huge economic areas, the Yangtze River Delta, the Beijing-Tianjin region. Millions of people have used it.
What's the big international advantage they're hoping for? Because domestic payments in China are already super advanced with Alipay and WeChat Pay.
Right. Domestically, it offers redundancy, which we'll get to. But internationally, it's about tackling the slow, expensive way money moves across borders right now.
The correspondent banking system.
Yeah, that whole messy network where your payment bounces between multiple banks, each taking a cut, each adding delay. We call those bounces communication hops.
Okay.
The ECNY, especially if built on something like distributed ledger technology, DLT, potentially allows for direct peer-to-peer transfers between banks or even companies across borders. Cut out the middlemen, cut out the hops,
Which means
faster payments, potentially real time, and much lower costs, especially around liquidity management, which is basically banks having to keep funds parked in different currencies all over the world just in case. That's expensive. P2P could change that dramatically.
that sounds like a huge potential disruption to the old system. But you mentioned a domestic reason too, redundancy.
Yes, this is crucial. Inside China, almost everyone pays for everything using just two private platforms, Tencent's WeChat Pay and Ant Group's Alipay. They are massive, systemically important.
Too big to fail, maybe?
Potentially. If either one had a major technical glitch or, a financial problem, it could genuinely disrupt daily life and the entire Chinese financial system. The ECNY gives the government a backup rail, a state-controlled payment system that keeps working even if the private giants stumble. It's about financial stability.
Okay, so the ECNY is one piece. What about challenging SWIFT? That's the messaging system everyone uses for international payments now. Let's use that second analogy.
Right, analogy two. If SWIFT is the old, established, maybe somewhat creaky railway network that just sends the messages about where money should go.
Then China's building.
China's building CIPS, the cross-border interbank payment system. Think of CIPS as the new high-speed rail line that handles both the message and the actual movement of the train, the settlement.
So SWIFT is just messaging, but CIPS does messaging and settlement.
Exactly. That's the key difference. SWIFT tells banks money needs to move, but the actual settlement often happens later, maybe through dollar accounts in New York. CIPS aims to combine both. For its main users, it uses real-time gross settlement, RTGS.
RTGS, what's the benefit there?
Real-time means transactions are settled one by one almost instantly. No waiting for batches of payments to be bundled and netted out, which is slower and involves counterparty risk, the risk the other side won't pay up. RTGS is faster and safer for the participants.
Is CIPS getting much traction?
It's growing steadily. It launched in 2015. By about 4 years later, it was reportedly handling transactions worth around 135 billion RMB a day. That's roughly 19-20 billion US dollars, connecting banks in nearly 100 countries. It's not SWIFT volumes yet, but it's a functioning alternative, especially for Yuan payments.
And this ties into geopolitics too, like the Belt and Road Initiative.
Directly. China is actively encouraging, sometimes requiring, that trade and loans related to its massive Belt and Road infrastructure projects are done in RMB using CIPS.
So if China lends money to Pakistan for a power plant,
They might structure the deal. So Pakistan repays the loan in RMB, and the trade for equipment uses RMB flowing through CIPS. This does two things. It increases the global use and demand for the yuan, and it lets both China and the BRI country conduct business completely outside the US dollar system.
immunizing them from potential U.S. sanctions on that trade.
Precisely. And the scale isn't small. Trade just between China and BRI countries was already over 9 trillion yuan back in 2019. That's building a whole economic bloc increasingly centered on the RMB and CIPS.
Plus, they have an advantage in actually getting people to use the digital yuan, right? Because of Alipay and WeChat Pay.
Huge advantage. They don't need to build a user base from scratch globally. They could potentially just integrate the ECNY wallet into the existing Alipay and WeChat Pay apps. Those apps already have something like 1.9 billion active users across 40-plus countries. Talk about instant distribution.
Okay, one more piece here. International cooperation. China isn't just building this alone, are they?
No, they know they need collaboration for cross-border stuff to really work. That's where projects like the MCBDC bridge come in.
MCBDC.
Multiple central bank digital currency bridge. It's a project involving the central banks of China, Hong Kong, Thailand, and the UAE. They're actively testing using DLT distributed ledger tech, think blockchain-like systems, for doing cross-border payments in real time. The tech seems to work well.
There's always a but, isn't there? This sounds like it leads to our first big knowledge gap. The tech works, but what's stopping this from taking over the world tomorrow?
Yeah, the tech is often the easy part, relatively speaking. The real challenge is organizational. It's governance. How do you get dozens of countries, dozens of central banks with different laws, different priorities, different levels of technical capacity to all agree on a single set of rules for a shared platform like the MCBDC bridge?
Rules like?
Like, who's responsible if something goes wrong? Who vets the banks allowed to use it? What are the data privacy standards? How do you handle anti-money laundering checks consistently across borders? Agreeing on a common legal framework and governance structure that everyone trusts. That's the massive hurdle. It's more politics and regulation than technology, and that stuff moves slowly.
Okay, so we've got the gold piling up. We've got these new digital rails being built. It definitely feels like a deliberate long-term plan. Let's move to Section 4, future implications. What does all this mean for the global monetary system, for the dollar's role?
Well, the first thing is the dollar's dominance was already shrinking, even before this latest push intensified. Its share of global central bank reserves has been trending down for years.
Really? From what level?
At its peak, around 1999, it was maybe 71% of reported reserves. By 2024, it was down closer to 57%. That's a significant drop over 2 decades. It's a structural shift.
And where did that share go? To the euro?
Some to the euro, some to the yen, but increasingly it's going to what people call non-traditional reserve currencies. Think the Australian dollar, Canadian dollar, Swiss franc, and yes, the Chinese renminbi, the RMB. The RMB has been a key beneficiary of countries diversifying away from the dollar.
And things like direct currency deals help that along.
Absolutely. Those bilateral agreements specifically designed to cut out the dollar are multiplying. We mentioned China-Russia trade going from 90% dollar usage in 2015 down to just 46% by early 2020 is dramatic. And China has these currency swap lines, basically agreements to exchange currencies directly, with over 40 countries now, worth hundreds of billions of dollars. It all chips away at the need to use the dollar for trade settlement.
This isn't just China either, right? The BRICS group seems very focused on this.
Very much so. The expanded BRICS group, BRICS Plus now, with the new members, collectively hold something like 42% of all global foreign exchange reserves. That's a huge chunk, and de-dollarization is openly on their agenda.
What are they actually planning?
Well, beyond just encouraging trade in their own currencies, they're talking about building their own payment systems, like the BRICS bridge, possibly using blockchain. And their own bank, the New Development Bank, or NDB, has set a goal. They want half of all their lending to be in the national currencies of their member countries by 2026.
So if they lend to Brazil, they want to lend in Brazilian reals, not dollars.
Exactly, which forces Brazil, and whoever they trade with, using that loan, to use more reals. It's all about creating ecosystems that don't automatically default to the dollar.
Okay, so this leads to the really big idea, the potential end game. The gold-backed yuan. We need to be super clear here, though. This isn't like 1948 again.
No, absolutely not. Let's be crystal clear. Nobody serious is talking about China promising to give you a fixed amount of physical gold for every yuan, like the old gold standard or like that disastrous gold yuan. That model failed.
So what is the concept then?
It's more subtle. It's about using the massive gold reserves they're accumulating as a source of credibility and stability for the yuan. It's about perception. The idea is that if the world knows China holds enormous amounts of gold, it might trust the yuan more, especially compared to currencies like the dollar or euro, where there are constant worries about government debt and money printing.
So gold acts as a kind of psychological anchor, enhancing trust, even without direct convertibility.
Precisely. It leverages gold's historical reputation as, real money and anchor in uncertain times to bolster the international standing of the yuan, which still faces challenges like capital controls.
And the reason this idea might actually gain traction now, it has a lot to do with worries about the U.S., doesn't it? Specifically, U.S. debt.
That's the crucial link. The potential appeal of a gold-linked anchor is rising in direct proportion to concerns about the long-term fiscal health of the United States. People look at the projections.
What are the projections saying?
Well, depending on the assumptions, some credible analysis suggests U.S. federal debt could reach something like 250% of GDP by the year 2050. 250%. That's unprecedented in peacetime.
How does a country even function with debt that high?
That's the multi-trillion-dollar question. The worry is that the sheer size of the debt, plus the rising cost of just paying the interest on it, creates this inescapable political pressure. Governments facing that kind of pressure historically have two bad options: massive, painful austerity-cutting spending, raising taxes hugely, which is politically toxic, or they choose a seemingly easier path, monetary devaluation, basically inflating away the real value of the debt but printing more money. History strongly suggests politicians usually lean towards inflation over deep austerity.
So the fear is the U.S. will be essentially forced to devalue the dollar over the long run to manage its debt. And that makes other countries look for alternatives.
Exactly. If the world's main reserve currency looks like it's on a path of managed decline, holding that currency becomes riskier. Countries and investors start looking for assets that might hold their value better. And gold, historically, has been the go-to asset in times of monetary uncertainty or debasement.
This sounds like it creates a really strong setup for the gold price itself.
It does. You've got this potential feedback loop. You have central banks buying gold for strategic de-dollarization reasons. That's steady price-insensitive demand. Then you have private investors increasingly buying gold as a hedge against inflation and potential currency devaluation. Both sides are buying, reducing the available supply, potentially pushing prices up significantly.
What kind of price levels are we talking about if these trends continue? I know it's speculation, but what are the models suggesting?
Okay, yeah, with the caveat that this is highly speculative and depends on those debt trajectories actually happening. Some models that try to figure out how assets would reprice in a major currency devaluation scenario are projecting truly eye-watering numbers for gold.
Like what?
We're talking potential prices of $10,000 or $15,000 per ounce sometime in the 2030s, and maybe even $25,000 per ounce by 2050 if the debt situation really spirals.
$25,000 an ounce. That would mean everything else would have to reprice against gold, wouldn't it? Currencies, stocks, bonds.
It would imply a fundamental revaluation of global assets, yes. Essentially, gold regaining a much more central role as a monetary benchmark, not just a commodity.
And it's not just about owning gold anymore, that where you keep it is becoming important too.
That's a really key point now. Jurisdictional risk. In a world where sanctions are common and assets can be frozen or seized, central banks are getting nervous about storing their gold reserves abroad, say in London or New York, even if it's allocated to them.
So they want their gold physically back home, or at least in friendly territory.
Increasingly, yes. We're seeing repatriation efforts. So it's not just about how much gold China or Russia owns, but where is that gold physically located? Owning gold in London might not help you much if you fall foul of Western sanctions. Geographic diversification of storage is becoming a big theme.
Wow. Okay, so pulling it all together, this shift away from a purely dollar-centric world toward something more multipolar, maybe anchored partly by gold, facilitated by these new digital payment systems. This is a really profound change underway.
It really is. Decades in the making and potentially decades still to play out.
So what does this all mean? Let's try to synthesize. China's huge gold buying and its push into digital currency with the ECNY and the CIPS system. These aren't separate things.
No, they're two sides of the same coin, really. Part of a coordinated, very long-term strategy. The goal seems clear. Achieve what you might call financial sovereignty.
Meaning insulate themselves from the dollar system and the geopolitical leverage that comes with it?
Exactly. And in doing so, gold is making a comeback. Not just as something shiny, but as a core strategic asset for central banks managing risk in this changing world.
The big picture view. Transitions between global monetary systems haven't always been smooth, have they?
Historically, no. Shifts away from a dominant currency, think the pound sterling giving way to the dollar, have often coincided with periods of major geopolitical tension, even conflict. Now, an orderly transition to a multi-currency world is possible, but history suggests we should be prepared for potential instability as this plays out. The fragmentation is happening now.
Okay, so with all that on the table, we want to leave you, our listeners, with some big questions to chew on, some knowledge gaps to think about as you watch this unfold.
Right. First knowledge gap question for you. China still has pretty strict capital controls, limiting how easily money can flow in and out. For the digital yuan, the ECNY, to become a true global reserve currency, not just a payment tool, wouldn't Beijing need to relax those controls significantly, offer real convertibility? And are they actually willing to give up that level of control? That seems like a fundamental tension.
That's a good one. Okay, second knowledge gap question for you. Let's say the dollar does continue to lose ground, maybe mainly because of the U.S. debt situation. Who actually benefits the most? Does the RMB automatically fill the gap, even with China's political system and controls? Or will investors and central banks prefer to shift more towards other established, more transparent currencies like the euro, the Swiss franc, or just pile even more into gold itself? Where does that dollar liquidity actually go?
And final knowledge gap question for you. We hear investment folks like Ringalio talking about maybe needing a 15% allocation to gold in portfolios now. If gold does regain more of a central monetary role, how does that change everything else? What happens to the traditional relationship between gold, stocks, and bonds? Does that old 60-40 portfolio model just completely break down? What new correlations emerge? That could force a total rethink of investing.
Fascinating questions to ponder. That wraps up our deep dive today into China's golden gambit and the shifting sands of global finance. Thanks for exploring it with us.
Dive responsibly, everyone.